I'm joined live in the studio now by two authors. Matt King wrote Are the Brokers Broken? Just 2 weeks before the Lehman bankruptcy, and he's now Managing Director and Global Head of Credit Product Strategy at Citigroup. Nicholas Dunbar has just written The Devil's Derivatives, and he edits the Bloomberg Risk Brief newsletter. Thank you both very much indeed for joining us. I just wanted to touch on what's happening today in France, because we've seen the bank stocks there plunging, and yet really nothing particularly seems to have changed with the fundamentals. Is there a reason for that specifically? There has been talk about a potential downgrade from the AAA credit rating. Is that doing all this?
I think it's a question of confidence, and at times like this, things move very rapidly. There's been a lot of focus on Spain and Italy. The focus has now shifted to France, and the focus is it goes immediately to the banking system and whether they can fund themselves, and the numbers are very large, the balance sheets are huge, so any lack of confidence just immediately filters into prices. And
we're beginning to see any little rumour actually having quite a significant impact on stocks.
That's certainly true, and investors have been worrying for a while, in particular about the large exposure to Italy that the French banks have, $450 billion worth, plus the large volume of short-term funding they do, especially in the US, and US investors have been becoming more concerned. But at the same time, one of the big differences between now and 2008 is that it isn't really about liquidity. You have the mechanisms in place. There are, ECB is offering unlimited size auctions. There is also the dollar swap line that's available. And so there really shouldn't be a problem with French banks or any other banks suddenly running out of money in quite the same way as we had in 2008.
There are, however, Matt, quite a few worrying similarities between where we are here if we think of subprime and, say, government debt. There are quite a lot of similarities between the way that those have worked. We kind of believed that subprime was okay until it wasn't. And in the same way, we sort of believed that it was okay to borrow an awful lot if you were Greece or Italy until it wasn't anymore.
Yeah, so you can break it up into sort of 5 stages really. With subprime, you had initially a bubble where everyone thought these were rock solid assets, been transformed using financial engineering to perfectly safe assets. Then you had the emergence of fraud and subprime, and the bubble bursting, lack of confidence in the institutions that owned these assets. Then you had the third stage was where everyone thought Uncle Sam will support them. They'll never let Bear Stearns fail. They'll never let Lehman fail. They'll never let Fannie and Freddie fail. And then you saw the political debate in the US go to not wanting to do that and letting Lehman fail. And that then created complete mayhem and then leading to a massive bailout. So that was in 2008. Going to 2011, you've had an analogy with the bubble in government spending and government debt issuance, the emergence of fraud in Greece's balance sheet or misleading numbers leading to the problems there last year. You've had the loss of confidence there, and then the analogous moment when everyone thought that the Germans and the Northern Europeans would bail them out. And then now you've had a feeling of political difficulties in expanding these bailouts, the headwinds against that. And now we're getting to a very tricky question of whether there needs to be a sort of Lehman experience to really force people to go the whole way and restructure the European Union.
Now, Matt, we have had an awful lot of things in place since 2008, from Basel and stress tests, in order to make sure that banks were not in the situation they were then. But crucially, all that government debt was considered to be rock solid, wasn't it? No, I mean, this isn't the first time we've brought this up. People have been concerned about that the whole way through. Could that be a catastrophe now?
If you were to allow Italy and Spain or even France to end up defaulting, then yes, absolutely, you have your comparison with 2008, and indeed it's even worse. But partly because of the involvement of Italy and Spain and even France, it's the likelihood of that is greatly reduced. And in general, there are certainly similarities between governments and banks. You can look and you can say, look, they're just like banks. They've got long-dated, illiquid assets, and then they have these short-term liabilities that they need to refinancing in the market the whole time. So yes, confidence is a critical issue, and it's exactly confidence in governments which is being eroded here. But at the same time, unlike 2008, precisely because the issues are just so large, we are getting closer and closer to the point where the European politicians will be able to say, look, we've decided to take the drastic step of moving towards political union and bailing out countries even if necessary, because it was better than the alternative.
You say that. Do you think that we are going to actually see that situation? I mean, Germany has tried terribly hard not to be in that situation for the last 2 years.
Do we need to see a disaster? You know, that's the troubling thing. I mean, look what's happened in the United States in the last couple of weeks. We had to go right to the brink and lose the AAA rating from S&P to get to some limited political agreement. We know the same kind of pressures there in Europe, the same disputes, and that's exactly what happened in 2008. Everyone thought everything would be fine until it wasn't, and that we had Lehman to make things change. So that's what worries me.
When we look at the banks in particular across Europe, are we seeing evidence yet of banks that are in more trouble in a way than governments? Because banks really do need to make sure that they're not able to kind of hang on to the debt. They need to make sure that they're actually making money more in a way that governments can bluster and sort of stay afloat for a little longer, can't they?
Yeah, I mean, there's a debate about how rapidly governments versus banks need to roll over their debt. Banks have deposits. What's dangerous for banks is that particularly when the money's sort of hot money, it's international deposits, wholesale deposits, they're very vulnerable to that fleeing. Now, we have seen, certainly for Italian and Spanish banks, we've actually done a study of data at the Bloomberg Risk newsletter, and we've seen that since last year, some of the biggest US money market funds, the Vanguards, the Fidelities, they've pulled their money out of Spain, out of Spanish banks completely. They've slashed their investment in Italian banks. These are very short-term deposits. They've slashed that by 50%. The last data we looked at, they hadn't touched the French banks, but maybe that's now changing. And there you need the governments to step in and keep them going.
Okay. Matt, do you think then that we could be in a situation that is as bad or possibly worse than we saw in 2008? Is it possible that we could be heading towards that scenario?
It is possible, but unlikely. Again, if you were to say the Germans were simply to walk away and say, no, there is no way we're supporting other countries, we're not going to expand the EFSF, then yes, it's highly likely that the market will take fright, and you could end up with a situation that's worse.
But you don't think that's going to happen?
But no, I think that when the pressure increases, Merkel does not want to have on her hands that she was the one responsible for creating 10 years of depression in Europe because they were the ones that didn't bail out Germany. It may need to get bad enough that she can say, look, German taxpayers, I am going to raise your taxes and give the money to Italy because it's better than the alternative, and we're not quite there yet. But nevertheless, I think when they look into the abyss, they will step back.
And where is that abyss? What is bad enough? What do we need to see happen before we get to that point?
The scary thing is that the politicians have consistently underestimated the role of confidence, underestimated the need to get in front of the snowball to now. But it is highly likely to be, for example, Italy and Spain entering the EFSF and people facing the potential inadequacy. Ideally, it shouldn't come to that. Ideally, the ECB would already be in there buying much larger volumes of Italy and Spain and propping up confidence.
But how long can they continue to do that?
They can, in principle, continue to do that as long as they want. There is no problem with them running out of money. There is no real threat in terms of their capital base either. It's that they are reluctant to do so because they don't consider it their responsibility. They think it's for the governments to do so. And until the EFSF is expanded, they don't want to do so. But if the situation becomes bad enough, the mechanisms are there.
Is that the kind of crisis point that you see, the tipping point that would need to happen?
It's the political risk. I mean, this is actually something which you see when you look at what a sovereign credit rating is. It's about willingness to pay. It's a firm, a company, or a special purpose vehicle. It's much more mechanistic. Its assets are less than its liabilities. It hasn't got the cash flow to service its debts. It goes bust. There's a credit event. With governments, with sovereigns, it's more to do with the people, that the political system just can't do it. It doesn't want to do it, and that's a much harder risk to quantify. It's we might look at CDS markets, we might try and understand it that way, but that's really kind of quite scary in the current environment.
Now, if we do see a downgrade for France, and we have been told that Moody's and S&P are not going to downgrade at the moment, but if we do see one, what kind of pressure does that put? Does this add to the cauldron that we have at the moment?
Well, the research shows that when you do have downgrades, there's research by the IMF it was published earlier this year that shows when you have European downgrades, you have contagion immediately. A lot of this is to do with the banking system and the fact that everyone knows that the French government has to stand behind these French banks.
Well, for now, S&P and Moody's have affirmed the credit rating, but we'll leave it there for now. Thank you both very much indeed for joining us today. It's been a pleasure to talk to you, and let's hope that we're not on the edge of that.
Okay.